As a Gen Xer, you're reaching that age where it's time to plan for your financial future. You're also probably at that age where your school days are far behind you. But it's not too late to learn something new. Class is in session. This is the Gen X Wealth Academy podcast with Phil Telpner of Breakout Private Wealth.
This is the Gen X Wealth Academy podcast featuring Phil Telpner of Breakout Private Wealth, a guy who's been doing this financial planning since 1987. My name's Ron Stutz. Yeah. I'm sorry to make you feel old right out of the break here.
Well, 1980. I mean, that was my first year in the industry, and just so everybody knows, I was 20. So, and it was a summer job. So, yeah, I've been around.
You've been around the block a few times.
You could see the wrinkles.
That's not your first rodeo.
No, not even close. But
if you'd like to have a conversation with Phil, 224-616-2016 is your number to call to make that happen. That is 224-616-2016. And Phil Telpner, of course, has this thing he has founded called the Gen X Wealth Academy podcast, a private community of Gen Xers where we will share strategies and answer the questions on the minds of successful Gen X families. And we're not talking about selling you anything like that. Phil Telpner is not sales focused at all. He's here to help. So let's talk about, we talk about financial planning on every show we do. Let's talk about the incomplete financial plan. You ready to attack this, Phil?
I even have notes, Ron. How scary is that?
Oh, my goodness, you prepared. That's great.
I prepared. We're going to keep this right on the rails this time.
All right. Well, before we go off the rails altogether, are you confident that your financial plan is complete? Many people believe they have a solid plan in place, only to realize later that they've missed important areas, from not accounting for long-term care expenses to overlooking the impact of taxes on retirement income. There are many ways a financial plan can be incomplete. On this episode of the Gen X Wealth Academy podcast, we'll be pointing out the most common areas that people overlook when planning and provide actionable tips so you can ensure that your plan is as comprehensive as it can possibly be. The number one thing on my list here, Phil, is the danger of a downturn in the market in the early years of your retirement is something that can devastate you. It's much worse than a market downturn in the later years of retirement. Why is it, if it happens, when you've recently retired, why is that so much more dangerous than if it happens later on?
Well, it devastates your ability to compound. So anytime you make withdrawals into a market that's going down, it impairs your ability to compound in the future. And to your point, 20 years later, if it happens, well, you've already compounded your wealth probably far more than you may actually need. Mm-hmm. You ready for a technical term?
Oh, yeah,
I'm
please.
Give you a technical term.
Let's
feel smart.
I may not understand what you're talking about, but I'd love to hear it.
I'll go slow for you.
Thanks.
It's called sequence of return risk.
Oh, yeah.
What does that mean?
I've heard you talk about it a lot more, so why don't you explain it better than I can? Yeah.
Well, let's just really simplify it. Okay. Let's understand this. The market doesn't care about you.
Yeah.
The market doesn't care about your family. It doesn't care about me. It doesn't care when you need money. The market just is. So too many people expose their short-term needs to risk assets.
Yeah.
Again, like we talked about in the other podcast, we're anchored to this weird interest rate, markets only go up and volatility's dampened type of situation, which that is not going to be the experience we're going to have here going forward. So we'll simplify it. If you need money in, let's say, 3 years of living expenses, 5 years of living, you need to segment that out from long-term investing.
Mm-hmm.
Okay. Now I'll put a caveat on that. Some people are significantly overfunded, meaning they have more than enough to ride out this kind of a downturn. But for people concerned or most people, having separate tranches, I guess, so to speak, which is a fancy word for segmentation or buckets, based on time of when you will need the money, is really the best way to prepare for a downturn. Meaning if you take it's everybody's situation's different, but say 3 years of living expenses here, and you keep it liquid and safe, let's say, then you take maybe another couple 3 years, depending on everybody's situation, into something that's still liquid but doesn't have as much or very much equity stock exposure, so the volatility is going to be dampened there. And then you have your long-term assets, right? Your 10-year plus assets. So what that does is, it provides comfort to people that their immediate needs are safe, quote unquote safe. Their medium-term needs are going to move a little bit, but are more or less conservative, super conservative. And then their growth assets are for, I guess, quote unquote later. If you can structure it like that, that seems to really help. It is not most likely the way to have the most amount of money at the end of your life, I suppose. But I would suggest that for a lot of people, this type of structure will avoid emotional decision making, which can blow up pretty much anything and just destroy your whole plan altogether. So something to think about, something that we implement for the right client. And again, if you heard me say, it's not, is it 3 years? Could it be 4 years? Could it be 2 years? Can that middle be 4 years, 5 years, 6 years? And the answer is always, it depends. Everybody's different. Everybody's situation's different. Everybody's comfort level is different. Everybody's needs and wants and all that. So that's what you should get from working with an advisor.
Certainly, financial planning is a complicated process, and one thing that a lot of people may be incomplete on when it comes to their planning. Let's say you're trying to do it yourself. If you have not accounted for inflation in the future, and my goodness, everybody ought to know all about inflation right now. If you've been to the grocery store or the gas station lately, if you haven't accounted for the effects of inflation over time, then your plan is definitely incomplete.
Yeah. Inflation's one of those things. It's like a little bit, then all at once, right? It's one of those things that you just don't notice until you're like, oh my God, what just happened?
Exactly.
And it varies, but let's just say that, maybe every 10 years prices double, somewhere in there, depending. Certainly when you factor in healthcare, we discussed education, all these other things, long-term care. I don't even know what they inflate at, but it's not the government spew of 2 to 3%. That's for sure.
And on the subject of inflation, I mean, the fact that medical costs are increasing at a rate even faster than inflation. I mean, that's really something else to deal with.
It's just brutal. And therein lies why we invest in the first place. Okay. Properly structured portfolio investment plan will grow and compound your wealth over and above the rate of inflation over time. That's not like, 3 months, 3 minutes, may not even be 3 years, but start looking out 10 years, 15, 20. That's really where the benefits of all this come into play. We as investors have to be compensated for taking a reasonable amount of risk, or nobody would invest. Companies wouldn't attract capital. So when you reduce it to its basic fundamental like reason for actually having or wanting to do it, to me, it really is how you going to keep up and grow your wealth over and above inflation.
That's a really good point you just made for, looking out into the future for Gen Xers. You got to look, 15, 20 years down the road or whatever the case may be. And another thing that is, I don't think it's a possibility. I think it's an inevitability that taxes are going to go up in the future. You got to account for those tax increases in the year ahead.
Yeah, we just touched on it in the last episode about taxes and retirement. And it triggered a thought here. So many people that I see, and we'll talk about my client base as we specialize in Gen X, they're doing really well with like their qualified accounts, their 401k, and maybe it's a solo 401k or whatever their situation is. What most people are missing is a taxable investment account. Mm-hmm. Okay. You're married or whatever your situation is, joint account can be a trust. What it is actually doesn't really matter that much, but having that after tax bucket of investments that, like you said, Ron, will grow and compound over and above inflation is critical to managing those taxes that you alluded to in retirement. Mm-hmm. So if you're in your 40s or 50s and your taxable account is your speculation account, we should probably have a conversation and rethink that strategy, because that's the one thing, don't forget, you can go into that bucket without tax consequence, capital gains, long-term capital gains, whatever, but without income tax consequences, which is key to managing your taxes.
Yeah. And another thing to think about, a really simple way to put it is, let's say you have $100,000 in a 401k. You say, hey, I got $100,000 there. Well, you really don't, because Uncle Sam's got part of it too.
Part of it, yeah. Probably more than part of it.
A big part of it.
Well, here, let's rephrase that.
Yeah.
Uncle Sam has part of it at a percentage that you do not know.
Mm-hmm. Yeah, you don't know what that percentage is going to be.
I have no idea. So, we've discussed that every rational person believes that tax rates will go up in the future. Therefore, you have an embedded liability in that 401k or IRA.
Yeah.
You owe Uncle Sam. You just don't know how much.
Well, another thing that a lot of people don't really think about is, when you're getting your 70s, you're going to be presented with the obligation to have your RMDs. Explain that, if you would. And what are the challenges presented by that?
Yeah, they just moved it to 73 with this Secure Act 2.0. So people think that's great. I think your account grows more, so you pay more taxes, so their revenue increases. Mm-hmm. I don't know. So required minimum distribution is, per the IRS at a specific date, let's just say 73 now, you have to take a certain percentage, and there's a table for it, it's not important, of your qualified accounts into income, therefore paying income taxes. And that's tax revenue for the IRS. Don't forget, all those retirement accounts that you have, you never paid tax on it.
And the government's saying, hey, it's about time we got some tax money out of this.
Yes, correct. The bigger the accounts, the bigger the required distributions. And, that can trigger all sorts of things. Increasing your tax on Social Security and Medicare. It's not just the RMD tax. It's part of the tax code. So, and again, there are strategies to try to minimize those. You can't minimize the distribute. Well, you can pay the taxes. You can Roth conversions, some other strategies. If you can pay the taxes now, that helps, because then you control you control the taxes on that forever. So if you pay if you pay those taxes now, let's just say in a Roth conversion, and last year was great to do it because prices were down. So the problem is you have to pay the tax out of a Roth conversion, with a check. You can't pay it out of the distribution, or to your first point today, it kills the compounding. It's not viable. It's not worth it.
Mm-hmm.
So if you have, but again, if you are in a little bit of an income dip when you retire, you can convert that to Roth at a lower taxable tax rate than you would when you were working. So provided you live long enough, it's a very viable strategy. Did that help?
Yeah, it helps a lot. I hope everybody is moving right along with us here today. This, of course, is the Gen X Wealth Academy podcast, a private community where Phil shares strategies and answers the questions on the minds of successful Gen X families. And one thing that we talk about a lot is, you just mentioned RMDs and tax increases in the future and all those other things. The likelihood that you'll have a long-term care need before you die, nobody wants to talk about that. But it's a distinct possibility and probably a probability. Does that make sense?
Yeah. So it's interesting. You mentioned fiduciary advisors. So as a fiduciary advisor, we have to have hard conversations, right? And my experience is that more people are okay with dying than having the long-term care / assisted living / nursing home conversation.
Yeah.
In a lot of ways, that can be somebody's biggest nightmare. But the hard questions require hard answers. So I tell my clients all the time, you can not have a plan, okay? But it's not going to be because we haven't discussed it for years.
Yeah.
It's going to be because you're choosing to not have a plan. Okay. Maybe that plan involves long-term care insurance for all or a portion of it. Again, easily taken care of when you're in your 50s, when you're in your 70s, not so much. So even for a portion of it, right? The statistics, and I'm just going to go kind of general here. I think a third of us will require long-term type care, and half of that third, I don't even know what the math is that, Ron, you can help me, but half of that third is for 5 years or longer.
Mm-hmm.
I know by me, quality care is probably, $10,000 a month.
Yeah, it's a lot. That's for sure.
Yeah. So and that's probably in 10,000 a month and up. Varies different, and it's not that really material. But the point is, can you carve out a few $100,000, let's just say, for long-term care?
Yeah.
Okay. Can you carve out 50,000, still, grow, compound your wealth, take the grandkids to Disneyland, whatever it is, and still have money in there, a large enough margin of safety in that plan to pay for this ongoing care?
Yeah.
Does it make sense to insure? There's really good insurance companies that have, 5-year payment options. I don't know if they have 10 pay anymore. I don't know, but 5-year for sure. So you can pay it over time, and like all insurance, it'll pay you more than you put in. And if you die, I think, you just get your money back when you die, I guess, and don't use it. The downside is your money doesn't grow.
Mm-hmm. Well,
so anyway.
Yeah, it's so much to think about when it comes to financial planning.
Yeah, that's why I have a job.
Getting you to and through retirement is what Phil is all about. And, there are certain things you need to take into account, and Phil is holistic in that way. I mean, he thinks about all these things that relate to your finances in any way. there is always the possibility of an unexpected event. Maybe you lose your job. Maybe you get laid off. Maybe, the company downsizes, or maybe the company's bought by another company and you don't have a job anymore. Or you get sick and you can't work. You can't perform your job anymore. That can deeply impact your finances. And Phil is all about preparing for you so that you are equipped to handle that kind of situation if it arises.
That's the human condition. You see much more people, it's not a linear, we all know, we're old enough to, life is not a linear proposition, right? There's ebbs and flows and resets and all sorts of these things can happen to you and probably can't eliminate them, or probably in a lot of ways can't prepare for them.
Yeah.
But certainly there are some that you can, and the better you are prepared, it's just like anything else, right? The better chance you have of withstanding whatever it is and coming out okay.
And the last thing I wanted to mention here about, having a complete financial plan is, again, as we always do when we talk about legacy, it's more important to some people than it is to others, but how to pass assets smoothly and efficiently to the next generation, and tax efficiently as well, or to beneficiaries in general. Think about what you need to do and do it in the most efficient way possible after you're gone.
I'll start with the easiest thing to do. And we do it every year for all of our clients. It's a beneficiary check. So every account that we have, everything that we have visibility to, we confirm the beneficiaries. I have seen stories of assets. We'll just use an example. Mr. and Mrs. get married. It doesn't work after 20 years. There's a $2 million insurance policy. Mr. gets married to this other nice woman. They've been married 30 years. Mr. dies. The second wife believes that she's entitled to the life insurance proceeds.
Mm-hmm.
They never change the beneficiary.
Yeah.
And there's no recourse. So that's the easiest way to do it. Okay. Minors should not be beneficiaries in my book. That's probably where a trust comes in. Here's where I got to say it. It's not legal advice. Consult your professional. Don't listen to some guy on the internet talking, but just be mindful of that. Okay. You do not, a minor inheriting assets can be problematic for a variety of reasons.
Yeah.
Asset transfer can be done via insurance. There's advanced estate planning strategies via trusts, so that can get complex. We see a lot of charitable gifting. I think they just raised the gift to $17,000 per spouse.
Mm-hmm.
So, you can help somebody out and get money out of your estate, because estate tax is like 40% or something. So here's the thing. They just raised it. It's like almost $13 million or something like that per spouse, I guess, so to speak, whatever that means these days. So it's pretty high, but managing that is a big thing, and that gets really sophisticated for people. For most people, figuring out what they would like to leave as a legacy, and working that into the plan, like we discussed with long-term care. Is your plan still viable if we take out $100,000 and leave it for your grandkids or whatever the situation is? And again, it's conversations and adjustments and all that, but and for some people it's not important, not material. Everybody's fine. It's definitely a personal situation.
Folks, when you're, in your upper 30s, getting close to 40, and all the way to the mid and perhaps upper 50s, you have unique concerns and common problems that need to be solved. And that's why Phil Telpner has this Gen X Wealth Academy podcast. And I hope you've gotten a lot of good information from today's conversation. Phil, it's been fun.
You're the best, Ron. Appreciate it. Thank you.
Join us again next time, and be sure and call Phil Teltner at Breakout Private Wealth. His office is in Glenview, serving folks all over the greater Chicago area and far beyond. 224-616-2016. That's 224-616-2016. Phil will be glad to sit down and talk with you. That initial conversation is not going to cost you anything and not going to obligate you to do anything at all beyond that. But certainly you can decide if you like to work together. The Gen X Wealth Academy podcast. Gen Xers, of course, in a private community where Phil shares strategies and answers questions on behalf of successful Gen X families out there. And we hope you will join us again next time on the Gen X Wealth Academy podcast. I'm Ron Stutz along with Phil Teltner, and enjoy yourself until next time.
Breakout Private Wealth, LLC, is a registered investment advisor located in Glenview, Illinois. Today's content is for informational purposes only and does not constitute tax, investment, or legal advice. Please consult with a qualified professional before taking any action.